What's going on YouTube? Trevor Financial here. I'm gonna make a quick little video. It's not gonna be more of a quick video. It's gonna be more like a little mini series on steps of growing your account. So when I first started out in investing and in the stock market and everything, I didn't have these pointers that you would think were fundamental. And I just kind of jumped in there, had one or two successful trades, and I was like, boom, I know what I'm doing. And that's where I fell short. And I don't want you guys, new investors or even old investors that are still looking for tricks and all that kind of thing, to go out and make these same mistakes that I made, because they can make or break your account and like really kill your enthusiasm with what you're doing. So with this list, the first one is make realistic goals. Now, when you try and go into the stock market, you can't go in there and say, all right, I'm going to invest $100. I'm going to be a millionaire by the end of the month. That's how you get discouraged. That's how you get no positive results. And that's how you just say, okay, well, I'm done because it doesn't work and all this. You're not setting realistic goals. You can't expect to get bigger if you don't go to the gym or if you don't work out. You're not setting realistic goals for yourself if you're not putting forth the effort to do what you're hoping and planning to do. Now, if you're making small investments or making a few $100s every now and then, and you actually are dedicating time and effort into going into it, then yes, you will have positive results. That's that as long as you're putting forth that effort. But if you're not putting forth effort and you're not putting forth the time and the research and all of the things that goes into buying a share and buying a stock and selling and doing all these things, you won't be successful with it because you won't have the necessary tools you need to succeed in the stock market. And that's something that I didn't do. My goals, when I first started investing, I always thought, okay, well, I see all these guys doing these great things with the stock market, and I'm gonna know exactly what I'm doing. I'm gonna go out here and I'm going to make all this money. All right, that is a lie. That right there, I should have known off the jump. Hey, that's not gonna make sense because these guys have been doing this for years, and you're just now starting out trying to be on their level. That's not how that happens. So make sure you set realistic goals, because if you don't, you'll wind up hurt and sad and disencouraged because you're not getting what you think you're supposed to get. All right. Number 2 on the list: ensure no downward trends. All right. So when you're looking at a stock, you don't need to look at it for where it's going now. You need to look at it for where it's been and how it's performing from there. So you look at it from the past couple of days, and you try and say you look at it and you say, okay, well, 3 days ago it hit a complete downward spike, but today it shot through the roof, over the past 2 days. That will be a stock that you could look into. But if the stock has a downward trend on it, don't invest in it and expecting it to spike up and save the day, because that's how you lose a lot of your money. Again, that's another thing that I did. I went out and bought GoPro. I mentioned it in an older video in my previous week. I went out and bought GoPro thinking, okay, well, GoPro is such a big name. It's bound to do good. It's bound to spike back up. And I wound up losing money a little bit because I didn't realize that downward trends were a thing. You would think big name, good money. No, that's not how the stock market works. That's not the case. So you always have to ensure that it has good trends before you try and go into investing, which ties into the third: quality positive patterns. Now, when you're looking at their patterns, you can't just look at them and say, all right, well, they're doing good today, which, doing good for one day and doing good for a week are two completely different things. Now, if the stock went from $6 to $12 in a day, that's good. That's one that I would really look into. But you also have to put into account what made it do that and how, and make sure that you're not overpaying for it. Because a lot of the times when stocks do that, a lot of people wind up selling right then when it gets high like that, and then you'll be sitting on a stock that you think would continue that trend, and then it kind of evens out, and now it's just kind of just floating, $12.01, $12.08, and then there you are, just kind of sitting on a stock hoping that it does better, when in reality it kind of already hit its peak and now it's just kind of evening out before it goes on the downward trend. Not all the time does that happen, but when it does, you need to make sure that you either get out of that share or that stock right then, or you need to ensure that you're ready to sit on it until it either does better or worse. Because just sitting and saying I'm going to sell it when it spikes again in the next couple of days, that's not realistic enough to where you say, all right, I'm comfortable enough to do this. And that's where a lot of people, that's where a lot of people don't see it when you're first starting out. So number 4, make sure it's a decent price range, which again goes in with number 3. So if a stock, for instance, is bought at $26 and the average high is, 24, 22, then you're overpaying for that stock. You're overpaying for it because it probably has a positive gain to it. It probably has a positive trend. Now, if it has a positive trend, I'm not saying don't invest in it, but I am saying make sure that you're not going to invest in something that's already hit its peak, because investing in something on its peak is about as pointless as investing in it at its lowest point and expecting it to go up. Because if you're intending to sit on it and just, keep it forever, cool. I mean, I would say go all for it. But in reality, you have to make sure you pay attention to their pattern of price. Because if you wind up overpaying for it, you'll wind up losing money when it goes down. And if you wind up underpaying for it, you'll make money when it goes up. But you have to ensure that you get out at the right time, which goes into number 5. Always take your profits. When you're just starting out, do not get greedy. I know it looks like, I know when you first start out, it looks great. You made a few dollars here, you made a few dollars there, and you're thinking, okay, it's going to keep going up, it's going to keep going up, it's going to keep going up. And you don't lock in your profits, and you wind up losing that money because now it's hit its peak and it's about to drop drastically, and you're losing more money than you could have just easily locked in your profit. Yeah, you might have that mindset of, oh, I could have stayed and made a few more cents or made a few more dollars. But in the long run, if you look at it, locking in your profit there, you take all that guesswork out, because what could have been and what would have been and what should have been aren't rules that you need to follow when trying to buy and sell stocks. Because if you try and get greedy and allow your emotions to take over and you say, okay, well, I'm sitting here at a $2 profit or a 5% profit, I should say, then, you would say, okay, 5%, that's really, really good, but maybe I can get 10. And then you wind up losing that percentage. And then now you're discouraged because you're like, okay, I lost that money. I could have kept that money. I could have just got mine and ran with it, which is what you should do. Because if you allow yourself to let your emotions drive your buy and share, or buy and sell, I'm sorry, you won't really fall well in the market, I should say, because I used to let my emotions drive my decisions, and I made a lot of mistakes because of that. So just make sure that when you're going through and you're just starting out your account, you follow these. And I'm not saying follow every last one of them, and I'm not saying that these are going to guarantee any kind of results or anything like that, but these are mistakes that I didn't follow when I first started out, and now that I'm following these same rules, I'm seeing positive gains and positive returns in my stocks that I've invested in. So these 5 lists right here, I say that you look at them and you take them with a grain of salt, because they are good points to be made. If you don't see yourself making these points, or if you don't see yourself being able to do this, then maybe you should either reduce the amount of investment that you're trying to do, or lower your realistic goals. Because if you're not willing to succumb to information and say, okay, well, maybe I should ensure that there's no downward trend, and then you say I'll just go for it and wing it, then at the end of the day, who really is to blame there? The guy who says, hey, make sure there's no downward trend, or the guy who says, all right, you know what, I'm just gonna go for it. So when you first start out, these are mistakes that are commonly overlooked. So I personally would recommend, you at least look into these 5 things, and maybe find more of them. There's bound to be more than this going on, but for starting out, these 5 things would help you more than not having them at all. So, just kind of look forward to the next couple of videos. It's going to be just tips, same kind of concept of growing your account from when you first start out to, once you're well invested into it, and so on and so forth. Because there's nothing worse than not having guidance when you're first starting out into the stock market and financial investment. So look forward to the next couple of videos coming up. As you see, I still have my little pointer stick. And have a good day.